What if I hadn't sold? The psychology and mathematics of the missed hold. Introduction. Few questions in investing are more emotionally charged than, what would have happened if I hadn't sold? This question usually appears after a stock, crypto asset, or fund rises significantly following a sale. It blends regret, hindsight, and counterfactual thinking. This research explores the psychological mechanisms behind this question, the mathematical reality of missed compounding, and how investors can respond constructively. 1. The psychology of regret. 1.1 Counterfactual thinking. Humans naturally imagine alternative realities. Behavioral research by Daniel Kahneman shows that we evaluate outcomes not just by results, but by what could have been. When an asset doubles after we sell, we do not compare ourselves to the market. We compare ourselves to an imaginary version of ourselves who held. This comparison intensifies emotional pain. 1.2 Outcome bias. If the asset rises dramatically, the sale feels foolish, even if it was rational at the time. But decisions must be judged based on information available then, not on outcomes known later. A correct process can still produce a missed opportunity. 2. The mathematics of holding. When investors ask, what if I hadn't sold? They are usually reacting to compounding. For example, $50,000 growing at 15% annually for 10 years becomes $202,000. The same capital sold after 2 years at modest gains misses exponential acceleration. Compounding is slow at first, then dramatic. This is why long-term shareholders of companies like Apple Incorporated or Amazon often attribute wealth not to entry timing, but to holding duration. 3. Why investors sell too early. 3.1 Fear of losing gains. After a gain, investors fear giving it back. Loss aversion pushes them to lock in profit. Ironically, many transformative investments experience multiple 30 to 50% drawdowns before long-term growth. 3.2 Boredom. When growth slows temporarily, investors seek new excitement. They rotate capital just before the next upward phase. 3.3 Social influence. If others move on, holding feels outdated. Narrative cycles shift faster than business fundamentals. 4. The illusion of perfect holding. It is important to recognize, not every asset that rises today was obviously destined to succeed. At the time of sale, uncertainty was real. Even legendary investors, like Warren Buffett, have publicly acknowledged selling positions that later multiplied further. Perfect holding is rare. 5. The deeper risk, selling winners. Many portfolios suffer not from holding losers, but from cutting winners too soon. A single multi-year compounder can outweigh numerous average positions. Selling early interrupts exponential growth. 6. Reframing the question. Instead of asking, what if I hadn't sold? A more productive question is, did I follow a rational process? If the thesis changed, selling was logical. If fear alone drove the decision, the lesson is psychological, not financial. 7. The emotional reality. Regret often grows larger than the missed gain itself. Investors replay charts mentally. They calculate hypothetical balances repeatedly. This mental loop can distort future decision-making, leading to hesitation, overcompensation, excessive risk-taking. Unresolved regret sometimes creates the next mistake. Conclusion. The question, what if I hadn't sold, reflects the tension between time and emotion. Markets reward patience, but patience feels uncomfortable in real time. The lesson is not to never sell. The lesson is to build a clear framework for why you buy, why you hold, why you exit. Because in investing, you will always miss something. The goal is not perfection, but disciplined participation over time.